Well, happy holidays, end of the holidays, or middle of the holidays, however you want to say it. Ladies and gentlemen, welcome to today's presentation, a follow-up to our discussion, of course, on limiting risk properly and the proper adjustments and income methods to have on your side to take your position from a low risk to potentially no risk and more. The gifts keep on giving with these positions, and of course I don't mean a bonus of the Jelly of the Month Club. For those of you who don't know me, my name is Mike Chupka. I'm the Director of Education here at Power Options and at RadioActive Trading. And all this month, we've talked about stock and portfolio insurance. We talked about our approach for the proper structure to limit risk in your trades. The benefits of the proper structure, where the insurance isn't just a capped floor to guarantee that we can't lose more than 4, 5, or 6% on any position, but also at the same time it can be used as a second asset to help us lower that initial at risk, potentially cancel all of the risk, in addition to using other strategies in the proper nested structure you may already be doing now. We talked about how to find the right trades, not only the tools, but the structure and what to look for. And last week we talked about timing of the adjustments and what to look for. Today we're going to go a step further into that discussion, looking at different ways to adjust the position and why we would need 12 different ways to adjust a position. With the market performance over the last few weeks, we've all seen the need for proper trigger points, that adjustments are just as important as the initial structure of the trade. We can't control everything in the market. All we can control is the structure of our trade, how much we're willing to risk, and how much we maybe hope we're going to make. We've seen the importance of having adjustments to lower the loss or convert the trade from, say, a bullish trade to a bearish trade, or maybe the opposite direction depending on your structure and the security that you're in or you're following. And we've seen the importance of having more than just one way to adjust a position to avoid the freight train of a straight down or even a spontaneous recovery as well. Whether you're just trading stocks, whether you're trading covered calls or cash secured naked puts, whether you're looking at credit spreads, collars, calendar spreads, butterflies, iron condors, or strangles, the adjustments are just important as the initial trade. October, November, December taught us that, and might have taught us that with an expensive lesson. Before we go further, I just want to know the audience right now, those of you that have joined us, we still have more people coming into the room. What strategies are you currently trading? Are you just holding stock positions with maybe a trailing stop or a stop order? Are you still in covered calls positions? Maybe cash secured naked puts that you've been rolling down? Are you managing or still holding credit spreads, debit spreads, vertical spreads, maybe iron condors or butterflies? Are you buying calls, buying puts, trying to follow the market? Maybe you're rolling in and out of straddles or strangles, having a call and a put in structure. When the market goes down, you cash out of the put, buy a lower strike call, and as it moves up, try to lock in some of that gain or go back and forth. Or are you currently at none? Are you currently mostly in cash after October and November? You're waiting on the sidelines. Do you see a little bit less volatility, a little bit more comfort level in the markets, and comfort level for your trades? Now, I only want to leave the polls open for about a minute or so. I don't want to be here too long. We do have a lot to cover. All right, so I'm going to go ahead and close the poll. I'm going to share the results with everyone here. So of those of you that answered, 17% are doing stock only. 33% are mostly doing covered calls, naked puts. You may have been rolling down, rolling further out in time and down in strike to hedge some of the loss you're taking. The 17% of you are doing credit spreads, debit spreads, the vertical spread positions. No one's really maneuvering in and out of straddles or strangles. 33% of you, sort of a tie with the covered calls and naked puts. You've pulled out of the market. You're waiting on the sidelines here and just waiting for a little bit of comfort. Okay, now let's follow that up real quick. Last poll for a long time, I promise. And I know that some of you have already pulled out 33%, but for those of you that are still trading, how have you managed those positions? Now, I know that those of you that are, of course, holding in cash, you closed out, you took the loss to avoid further loss. Okay, can't fault you on that. For those of you that are trading stocks, covered calls even, have you averaged down, simply rolled down the call, maybe further out in time, hoping that it's going to recover? Some of you doing the spreads, have you closed the bull side, the losing side, and left the bear side open, or maybe rolled into a bear side, or did you convert from a bull spread to a bear spread, or vice versa, depending on the strategy as the market shifted against you? And right now, do you have no real management plan in place? Are you just holding and hoping for some calmness, some lower volatility, maybe confirmation, I should say, of a direction, lack of a better term? So you have no real management plan, whether you're in a strategy or not. All right, so I'm going to leave this open for another 20 to 30 seconds or so, 15 to 20 seconds. Got about half of our audience voted. Okay. All right, looks pretty good. Let's go ahead and close the poll. I'll share the results with everyone. Now, 40% of you closed out, took the loss to avoid a further loss. I can't fault you with that. It's always a good strategy to do, even though you took a loss, waiting for another time to make some of that back. 20% of you averaged down, or simply rolled down your strikes, looking to hedge some of the loss and hope for a recovery. No one closed the bull side and left the bear side open. If you're in an iron condor or butterfly, no one converted from a bull to bear, or vice versa. When a bull put starts to go against me, there's two ways we teach that you could take the bull put spread just into a bear spread to still profit, hopefully, on the position. But 40% of you have no management plan right now. You're still holding on and hoping for a recovery, or maybe you nibbled down at the bottom there as well. All right, so let's go ahead and hide that and continue on. The good news is I have a solution for everyone. For those of you that are just trading stock, well, the initial structure alone protects the stock, and it's not just putting money into insurance and increasing your break-even by getting the proper structure. It's a way to use that insurance as a second asset going forward. Also, a little later, I'm going to show you some material on what's called the stock repair tool to help you maybe get back to break even faster with your stock positions that are down in price. Covered calls, naked puts, well, rolling down and out is a solution if and only if the market recovers. But every time you roll down on a covered call, you bought a stock at 50, maybe you sold a 52.5 call for $1, the stock's now trading at 44, you buy to close that call cheap, 10 cents, 20 cents, and you roll down, sort of hedge this $4, $5 loss you're taking. Well, you probably still want to stay out of the money. Maybe you're looking at a 47, 47.5 call, but you've got to go 3 or 4 months out to get any decent premium, maybe $2. So you're locking in some of that loss, and if the stock gaps up quickly, you've got to be prepared to recover because you might just have to roll back up to not get assigned at a loss. Naked puts, you may get assigned the stock at a higher price and then manage it differently with the stock repair, I would suggest, or converting it to a covered call. But if it's too far gone, you might have bought back that put at an expensive price and rolled down 3 to 4 months and at a lower strike. Credit spreads, well, if you look for a credit spread with that 80% probability, you know you're taking a 9 to 1, 10 to 1 risk-reward ratio. You may have seen positions that hit a 60, 70% loss of the difference in strike prices. But if you're only getting an eighth of a ninth near-term credit against the risk, in order to make back that 60 or 70%, you've either got to move the strike prices and go out 4 to 5 months, and who knows what could happen during that time frame. Or you've got to close the position, take the loss, and hope you can make it back with other strategies. Buying calls, puts, straddles, strangles, no one was really doing those, but it is dependent on timing. If I start with a straddle with the plan to roll down the put when it takes a profit, move the call when it's losing, I've got to try to pick the bottom and then pick the top to make the proper adjustments. And if you're sitting on the fence in cash, 40% of you had done that, I believe, there's nothing wrong with that again. I can't fault you for being safe, waiting for a better time to get in. There's nothing wrong with that. But we also don't want fear of missing out. Or, I really want to trade with no fear at all. And that's what the proper structure that we teach here at Radioactive Trading gives us. I have a position at the start that gives me a controlled risk. I have a put that's far out in time, so time is on my side. Yes, the put is slightly in the money, which looks expensive, but it's designed that way to work as a second asset that I can manipulate in bad markets, in the worst case scenarios, to lower that risk without putting myself in a position of capping the gains or selling premium to obligate me. Yes, it's a bullish skew, but that is why there are 12 adjustments that work if the stock moves up, if the stock is stagnating, or even if the stock has fallen in price. We showed a little bit of that last week with the Starbucks trade, how we were able to reduce the risk slightly, but drastically reduce the break-even, even though the stock was down 7% in the first 30 days that we opened the position. We're going to look at another example of that kind of adjustment today as well. Now, why are there 12? Well, a few days ago I posted a quick 2-minute video. Do holiday crafts and investing have in common? Might have been a little kitschy, but it's just a fun thing. Did share something important, that we need more than one tool to help us get to our goals with investing. So in order to go from blank slates of wood to a special kind of holiday design, holiday crafts, of course the image didn't show up, but I need, shows up on my slides of course, it doesn't show up when I go through, I'm sorry that, but what am I going to need here? Well, I'm going to need 8 or 9 different tools, right? I'm going to need a tape measure, I'm going to need a saw, I'm going to need some sandpaper here to get out the finest points, I'm probably going to need a drill at some point or another, I'm going to need some wood glue perhaps a clamp or sort of a vise here to put these things together and hold them in place, a staple gun as well to attach positions and to attach the wood together. Right? So I'm also probably going to need tools to fix things if I make a mistake. File or a rasp, maybe a rotary tool of some kind, pair of pliers to pull out Allen staples. You get the idea. Sorry the picture wasn't there. But in order to get from blank slate to the desired finished product, I need multiple tools. And to me, it's the same thing with investing. My goals with the radioactive trading technique is to go from a limited risk structured trade where I don't have any fear of the unknown because my risk is controlled. And it's not only controlled. This is far out in time. This structure here, we bought stock at about $41. Yes, it's at $37.35, but the energy position we opened on December 18th, I bought it around $41.35. And I bought a January 2020 45 strike put for $6.90. Now this is a current position. If I got in an NRG today at $37.35, I might buy that January 2020 40 put, so I have a risk of 7.5%. It's a proper structure, it's limited risk, but time is on my side. What do I mean by that? The put, if I bought this 40 strike put at around $6, stock today at $37.35, bought it around $5.90 or $6, the 40 put, yes, my cost basis is $43.25. This maximum risk and this break even of $43.25 only occurs at January 2020. Okay, about 385 days out in time from now. If I do nothing on the position between now and January 2020. I make no adjustments. I accept no dividends. Yes, in that case, on expiration, 385 or so days away, I would need the stock to be trading above $43.25. If I open this position today, I could turn around right now and sell the put for $5.80, $5.70, maybe $6 if it's moved up, and sell to close the stock at $37.25. All I'm really risking is the bid-ask spread of the put. And because I put time on my side, unlike just going 1 month out in time on a wasting asset that's an out-of-the-money put that was cheap, the put's going to retain most of its value. So at the halfway point in July, even if the stock's trading right at around $39, I'd be essentially at break even because there's still another 6 months of time value holding on that put. But I'm not just going to sit here and do nothing. I'm going to manage the positions, but I don't feel the pressure to manage it. I have a controlled risk and I can wait until I think I've hit a time to make the proper adjustment. Okay? But if I want to go from this, which I do, I want to go potentially from this to a position that's bulletproof, essentially has no risk, a bulletproof trade with a little bit of income generation where I can profit on either side if I think the market's stagnating, or if I'm unsure of the market and I think potentially that it could fall or it could rise, I can set up a structure that can have me profit in both ways. So the market's up, I can cancel that risk. If I think it's still going up, leave the upside open and look for and wait for a better opportunity to generate more income. If I think the market is stagnating, I can set up a structure that generates income, lifts that risk up, puts me in a bulletproof trade in either direction with a peak right where I think the stock's going to be trading. Or if it's the unknown, I can take that position because I had it set up properly to begin with and structure it to profit in either direction in an unknown market or a volatile market as we've seen. But one adjustment, just averaging down with the stock position if it falls, rolling down the call in my covered call in a few months out in time to sort of try to hedge the loss I'm taking. Okay? I need more than one adjustment to meet my goals because there's different market conditions, because there's different expectations after a market event, and we all might have subtly different goals. One income method I use, you could look at and say, well, that's pretty good, but if I think the market's going to do X, I do something different. And that's fine because it meets your goals. There's not just one tool for every product, and there's just not one tool for every strategy. So when I approach different market conditions, I have different expectations going forward. I evaluate my goals. That determines my action. This is what we call the CEGA model for applying the different income methods in the radioactive trading techniques. And the CEGA model is taught for each income method inside the blueprint. But you came here to see some of these examples. You came here to sort of see how we're differentiating between what we do and which adjustments might work best. So we're going to take a tale of two trades. We're going to go over to the Power Options tools, and we're going to show comparison of adjustments from the blueprint on winning trades in this market. Yes, we're going to base it on a webinar attendee, JD, his inverse ETF married put that he opened and what is possible now. And then I'm going to take it the NRG trade we opened for you during the webinar on December 18th, which is a losing trade. But we're going to see what can be done with the current market conditions, what are my expectations going forward, and what are my goals based on what's happening now and what can happen going forward. So I'm going to pause the screen here, navigate over to our Power Options tools. I think I am going to move it over here. Let's take a look. Now, I'm going to leave it where it was. I'm sorry. I'm going to use the larger screen view just so it's more clear. Okay, now, there we go. So what we're looking at here is our Power Options trial account. We'll talk more about that later. What I want to do right now is I'm going to go to our portfolio tools. Yes, I have tools for various strategies, married calls, married puts, and more, where I can search across the universe of options based on my criteria by symbol. We talked about that the other week. we're going to go into the Portfolios tool, and we're going to look at the two open positions. Before we look at the adjustments, let's review. The NRG position we opened together on December 18th, and I posted for the Fusion subscribers, put in my personal account here. We opened the stock at 41.38, and we bought that January 45 put at the time in the money, far out in time for $6.90. Well, the stock's trading at $37.91. We're down $3.47 on this position, roughly 8.4%. Now, at the same time, I haven't made any adjustments on this position. The Energy Married Put started off with a maximum risk of 6.8%. Even with a decline of 8.4% in the past 9 days, I could liquidate right now and only take a 2.9% loss. Now, if I take a 2.9% loss, I'm only going to need about a 3% gain to get back to break even with what I have left. If I take a 8.5% loss right now, if I had just owned the stock, didn't have a stop order, or set my stop at 9%, but if I take an 8% loss, I'm going to need closer to a 10.5, 10.7% gain to get back to break even. Now this is what's known as gambler's ruin. If you take a 10% loss, you're going to need an 11% gain to get back to break even. Still possible. But if you take a 25% loss that you might see on a spread trade or a leveraged call, a calendar spread, well, you're going to need a 33% gain on what you have left to get back to break even. And many of you may be looking at positions right now that are down 33%, not stocks, but on the spread trades, leverage positions. And if you take a 33% loss, you need a 50% gain of what you have left to get back to break even. But even with this tumultuous market, you can say I timed that trade exactly wrong. But I opened it during that webinar because I have confidence in the structure. And I know that I couldn't lose that 6.8% really until I hold the position all the way to January expiration. Still several days out in time. 385 days out in time or more. And right now I still have only a limited loss. And I can make that back up. Some of it. Maybe not all of it. Yeah, we're still 386 days out. Now let's take a look at the winning position first. SH, the inverse S&P 500 ETF. JD brought this to our attention, his position on our Friday open forum webinar. Cost basis for him is $30.77, and he owns the 33 put. He legged into it a little bit later, but he does own the 33 put for only $2.30. Hey, so he opened one around the 1st of December, waited for a little gain, then legged into the put at $2.30. So yes, it's not an intrinsic from where he bought it. It should have been at least probably $3 or so, maybe $3.20, but he legged into it. Okay, so let's take a look at the position. Right now it is up to $32.29. He could liquidate the position right now for a 5% gain on the position with no adjustments done yet. And of course he only has a small risk going forward, but he still has 141 days out in time. Now, using the power options tools as I track any position in the portfolio, if I'm even trading just a stock position, or I should say tracking a stock position in our portfolio, I can go to the position actions view and the position analysis tool to see potential rollout opportunities or adjustments, where all the math is done for me. As I'm tracking this married put here, go to position analysis. Let's get that Adobe Flash going. There we go. All right. So we see the structure of the current trade. It's a winning trade, and it's still moving up in price. Don't worry, we're going to take a look at a loser in a minute. But I see here, there's my liquidation. If I sold to close the stock and sold to close the put, we'd have a current return of 5%. If I continue to hold it all the way to May expiration and the stock stays at $32.29, yes, we'd have a loss of 0.2%. Now, down below this breakdown, we see what are called the rollout opportunities. We see various positions here where we could bulletproof the trade by simply selling a call. 33% of you are doing covered calls and naked puts right now, but this allows me to do it in a structure that's already protected. I can still generate the premium without having any fear of continued downside. In the proper structure, that's a possibility. Let's take a look. So we can see here I could sell the February 33 call, get about $1 in premium. Now that gives me a potential max 8.2% return if assigned. My new cost basis drops down so that now drops down to 32.07. So now, with still having the 33 put in place, I have a guaranteed profit of 93 cents or 2.9% with the potential to make 8.2. So that sounds like a good trade-off, doesn't it? Now, right now we could liquidate for 5%, but we could go forward 50 days at a time, probably further than I'd like. But it's a possibility to where I could make 8.2% and still, in the worst case scenario, or if I'm wrong, still guarantee a profit of 2.9 in either direction. So let me go to simulate trade. This gives us a side-by-side comparison of this position. My original position on the left in red, current return 4.7%, max risk of 0.2. Just by selling the call, simple thing 33% of you are doing, but inside the proper structure, I can now guarantee a profit 2.3 to 2.9%, getting it at midpoint. Lower the cost basis we mentioned to 32.07 with the potential to profit at 8.2%. Why would I do this? Well, again, I can increase my profit from where I am at 4.7 to 8.2 if I think the market's going to stagnate. If I think in the next 30 to 40 days, this security would stay around $32, $33. That's the new position. But at the same time, if I'm wrong and it gaps up, the market recovers drastically, well, I can still adjust this call as you covered call traders would do. That's discussed in the blueprint as well. But I still have a guaranteed profit to the upside, and if it collapses further, if the market recovers, in this case SH would drop, I have a guaranteed profit to the downside as well. Well, that's one opportunity. Why would I choose this? If it matched my CEGA model that we discussed in the blueprint, the current conditions, my expectations going forward, what are my goals, and that would determine my action. So the current conditions, hey, we saw a pop yesterday, but we were pulling back here. I may think this stock might continue to move up, but I'm not sure. Well, that might not really match this adjustment. Here, I would say, well, the market's been fluctuating, but I think it's calming down. My expectations is that this particular security would be inside this range within the next 30 to 40 days. My goals, lower risk further, generate income, and increase the profits from where I am right now if my expectations are met, and that determines my actions. And that's how the CEGA model works, and it's taught for all of the 12 income methods. But again, what if we have a different expectation? What if I feel the market's going to continue to move up? Let me talk about it this way. What if I think the market's going to continue to be weak and move down? I'm in SH, which I'm not. This is JD's trade. But I'm in SH, and I think the market's going to continue to move down, in which case my inverse ETF is going to continue to move up. I don't want to cap the gain. My expectations are this security is going to continue to move up. I want to realize further upside profit, but you know what? In case I'm wrong, I want to guarantee some profit on the position. Now, it doesn't show up here, but we can take a different analysis. So that was income method number one, just selling the call, and in this structure, it could work if it matched your expectations. But again, I'm going to go to the profit and loss chart. We know we have an already low-risk trade on the position. It's continued to move up. But even if this was a 3% or 4% risk, I have a May put. I paid $230 for that put, The stock's now at $32.29, so I expect this to drop in price. But I probably have more of a gain in the stock. Well, I do, absolutely. I have more of a gain in the stock than what I lost on the put. That's why we'd be able to liquidate right now for a profit. In addition to that, this has not gone to zero. And it's not just trading at 71 cents, the intrinsic value, because it still has all the time value out to May 2019 expiration. And I can manipulate that in multiple ways. But the way I might do it today, which is what JD asked on Friday, I could sell this 33 put. You see, what's interesting is that with increased implied volatility in this case, we're actually looking at a slight increase on the bid-ask spread. At midpoint, we'd get 245. We paid 230, so we're actually getting 15 cents of profit. Even if this was at a small loss, you know what? What's cheaper than the 33 put? If I'm unsure of the market, I want to control or limit or eliminate all of my risk to bulletproof the trade. Still leave myself with some upside. But what's cheaper? The same strike put, closer in time. Here we're only at about 180. So in my cost basis for this entire trade, 33.07, that's already factoring in the stock plus the cost of my initial put. Selling my existing put for 245 and buying a new put around 180 actually is going to lower my cost basis but keep the same insurance for a shorter period of time. Is that a fair trade-off? I now have a guaranteed profit of 2%. We lower the cost basis to $32.39. We're still holding a 33 put. So if the market continues down the next few days into the first few weeks of 2019, SH continues to move up, I can still take further benefit of that and wait to find a good opportunity to sell premium at that time if I think the market has peaked, if I think it's going to pull back, or just continue to wait and still have the upside open. So my CEGA model for this, what we call income method number 3, which is a great play, is also referred to as the bulletproof vest, but this is a great play to use on standard stocks before earnings. You know, I bought a stock, let's say, like Starbucks. I already did this in the webinar for you the other day, but I bought a position with Starbucks and it's sort of down a little bit, or it's hanging out, stagnating to down in price. I've been in it for 30 days. I've got earnings coming up in 25 days. I could take that time value in and lower or cancel my risk. Yes, it's a shorter time frame, but if my earnings were in January, I might roll that Starbucks put from 2020 January into February. Lower the risk going into earnings. If it collapses due to poor earnings, I've lowered my risk or set myself up in a proper structure to maybe have canceled all of the risk. And if it gaps up for surprise earnings, I left my upside open with no fear going into earnings. So the conditions, hey, the stock's up, I have a low risk trade, I want to bulletproof the position, I think it's going to, expectation, continue to move up in price, and I don't want to cap the upside. What are my goals? Lower and eliminate all of the risk, still leave the upside open. I would choose income method number 3. Selling the call wouldn't have solved the goals or the expectations if this was the case. But this other tool, this other income method, absolutely does. And of course, there's also the market unknown. We're taking in $245 of premium in this case from our original cost basis where the put was already countered. Now I'm taking in premium and using that to stay at the same insurance policy, shorter term and cheaper value. What's interesting, another approach, and we saw this in the screenshot, I don't know what's going to come next. What are my current conditions? SH has continued to move up, and I have a very low risk position. What are my expectations? I don't know what's going to happen next. If the market does start to recover, I know SH will drop in this case, so I'd have a low risk. If the market continues to fall, I have upside. What if I wanted to see this to profit in either direction with a low risk position? It's not 1.9 anymore, still at the 0.2%. What if I wanted to profit in both directions? That's another income method. Okay? What I could do in this case, let's say I want to be protected for another 22 days, let me just put another $1.40 into the trade. This is done at a debit. Remember, I already have a low risk trade to begin with. Let me just buy a shorter term put and keep my long one in place. And now I have a position that to January has no risk. Even if the stock's trading right at 33, that May put still retains its time premium. My January put might expire worthless, and yes, I put an extra $1 in, but if the stock's trading right at 33, I still have no risk. If the market recovers and this inverse ETF drops, I have unlimited profit to zero to the downside. And if it continues to move up, I still have that unlimited profit to the upside, and I could fund the price of this with another income method, a riskless spread trade. Income method number 6. Now, I'm not going to show that, but that is in the combining income methods chapter, ways to combine 12 and 6 to profit in either direction, leave the upside open, but at the same time generate income to help pay for that new cost that gives you the benefit of both directions. Okay? Those are 3 ways alone to work on a winning trade based on your CEGA model. And by the way, let's go back to square one. We showed that simple income method. I believe it was selling the February 33 call for about $1, maybe $1.05. That gave us guaranteed profit in either direction with a little peak of maximum about 8.2% potential return if we were correct. Okay, so we saw that going in. Let me go ahead and run that one more time. I'm sorry, folks. It's being a little strange now. All right, but let's just, I'm going to go here. Let's go back to where we were. Finish up? Yes, it did. I'm sorry, folks. So this is what we kind of saw with that peak of around $262, $268, 8.4%, just by selling the call. But if this did meet my expectations, that I thought in the next 50 or so days, the stock was going to be trading around this peak, so I followed the income method number 1 idea with the CEGA model in this structure. But is there another way to continue to cancel risk? Sure. If I've already decided that the stock's going to stagnate around that time to February, but I want to have the lowest risk in unknown market conditions, why don't we take that number 3 adjustment we saw, the Bulletproof vest, and throw it in with selling the February 33 call? What did we do? We sell the May put now, which still has time premium in it. We use that to fund a cheaper, closer input at the same insurance policy, $33. And we sold the call in addition to that, so we have the same structure. Did I do that backwards? No. No, I did that right. So we have the same structure, but come February now, we've got a guaranteed profit of 5.5% in either direction, with that little bump here in the middle as well. So that's a combining income method, 3 in 1. I did shorten the time. There's pros and cons, but I did it because it matched my CEGA model on the trade. So obviously we started with a bullish skew. We had a low risk, unlimited upside potential. It is a bullish skew, and naturally there's 5 or 6 different income methods I would use if the stock continued to move up based on my initial expectation. If the stock stagnates, I've got a few income methods I can do and a few tricks up my sleeve that are taught in the blueprint. And if the stock falls, there's still other things I can do as well. Let's take one more little quick view here, back to the portfolio. Let's refresh it to get some current numbers. Stock's at $37.95. I bought at $41.38. Lost $3.43. I've gained $2 on my put from $6.90 to $8.95. So yes, the stock's still down 8.3%. We're only losing 2.9% if I liquidated the position right now. Not bad at all. That's the benefit of insurance. But can I use this as a second asset to lower the initial at risk, lower my cost basis, or do some of the same things we just saw with SH? Again, starting point here using power options, I'll go to position actions, position analysis. Now, I don't know if anything's going to show up, by the way. So here's my breakdown of my original position, max risk of 6.8%. It's important to see the earnings 63 days out, so I know that even if I do sell a call to February or something along those lines, I might not be capping my gain or doing something before the earnings comes out. That's good to know. Gives me some freedom to act in January or February to help lower this risk. Now, of course, we know we're at a loss of 2.9% with a stock that's down 8. And we see here's some rollout opportunities. Stock's down 8.3%, gives me a little description. I could lower my break even, currently at 47.38, 48.28. That's my initial cost basis. 48.28 is my initial cost basis. I could lower the cost basis by $2 by selling that January 2020 and moving in. Keeps the risk at about the same, shaves a little bit off, but now I'm holding a June 43 put. Still plenty of time, but I've taken $2.50 off of my cost basis. That's income method number 9, moving it down in strike, but also in closer, sort of a 3 and 9 twist. It's already showing me sort of a combining income method here. Rolling down to these I don't think makes a lot of sense. It's shown because it's a possibility. If I think this NRG has hit the bottom and I want to drastically reduce my cost basis but still keep my put out to January, if it matched my CEGA model, I could roll down this January 40 put. It would increase my risk. In the blueprint, we talk about why you would do this and the pros and cons. But this one is kind of attractive, isn't it? It's a thought. I could lower my cost basis by about $2.50. My risk stays about the same. Yes, I have shorter time, but a faster way to break even. It's almost like averaging down the stock, but I'm getting paid to do it. How am I getting paid to do it? I can sell my January 45 that was properly structured for $8.80 and buy this put here for $6.60. I'm lowering my break even by that $2.20, $2.40. That's taking in income, even though it doesn't look like it, but it's taking in income on my position. And then again, the side-by-side comparison looks very similar. It's still a married put position with about a 6.5, 6.6% risk, but I'm also now at the 43 strike instead of the 45. So if this recovers and moves back up to 40 or 41, I can sell a call at a lower strike that makes sense without creating a position that could lose two ways, which would happen if I sold a call now. Is this the right adjustment? I don't know. I did this on Starbucks. This is what we kind of showed. I moved the put down and closer in. We lowered our cost basis, lowered our maximum risk on the position, slightly, not a lot, but put ourselves in a better position to realize more profit if the stock does move up as we expect going forward. All right. So there's also a combining income method here. This is shown too. 9 and 1 combinations doesn't really do what I want with the risk. What else do we know? Based on the rules in the blueprint, power options showed me a 9 combination and a 9 and 1. I know earnings are out to February. Showed me rolling into June. Could I roll into March? Maybe April for a lower cost to lower that risk further? Didn't see it, but let's take a look. Go into what if calculations. This is just the standard position, same as the profit and loss chart. Original cost $41.38, here at $6.90 for our 45 put. Total in is 48.28. Max risk is 6.8%. We know the stock is down. We saw a June opportunity. There is March. There is a March. Let's take a look. So I'm going to manually simulate closing that 45 strike put that's moved up to 880 to 910. If I get midpoint, it's going to be a little bit better. If I sell to close the 45 put, it essentially leaves me with a stock trading at 39.33. Bought it at 41.38, paid 690, already accounted for, selling it for 895. I lower it by 205. Now, we saw the June structure. Pretty good. What about the March? And the stock has dropped, so maybe if I think it's going to recover, but let's go to the 41 strike. Got a reasonable price, but a much lower strike. It's 430. What does this do? Well, I've got a risk of 6%. Even with the stock down, I've hedged about 0.8% off of my initial risk. But I'm holding a 41 put instead of a 45. So that means if the stock starts to recover, not only do I get back to break even faster, but I could sell a lower strike call, the 41 or the 42, which I couldn't do without creating a bearish position or two ways to lose if I was still holding the 45 put. Gives me better opportunity for other adjustments going forward with a lower risk, even though the stock is down 8%. Maybe that doesn't solve my needs. Maybe I think the stock is going to continue down, and I'm worried about that. Well, one thing I could do, of course, don't normally do this, but just as we saw before, what do I know? We know earnings coming out the end of February. I want to stay in March so I can cross earnings maybe with no fear or with a low risk. What if I did the same thing? Let's sell that January 2020 again, 45 put, as we saw before. Well, we come into March, staying in through earnings. And instead of buying the 41, I think it's too far. I'm going to stay with the 40. Yeah, the 40 is good. I'm going to stay with the 40. Mid price at about 365 or so. But I'm going to take that 895 in. And now I'm going to buy two of the March 40 near terms. So I'm lowering the price, sort of an income method number 9. I'm shortening the time. Now, I don't know if I would do this, but going into earnings on February 28th, I have the potential for still only a 300 max loss if the stock's trading right at 40. But if it continues to fall between now and earnings, I can further adjust it. If it recovers back up, I can adjust it. Or I can stay and wait to go through earnings to whatever happens next. I still have a controlled risk in place, can profit in either direction. This isn't a structure I would potentially do, but it's a possibility. To profit in either direction, it does increase the risk, which is probably why I wouldn't do this one. I like the way of benefiting in either direction, but it's not quite the structure I would use. That's not quite it. But did we see ways that we could potentially adjust this position down 8% from where we got in a bullish structure to lower the risk, leave the upside open, and still have the potential to do adjustments and go through earnings with something better than a stop order? So if I hold this through earnings now, lower the risk down to 6%, I did shorten the time frame, but I'm preparing myself for earnings. In a stock that's down from where I bought it, I've lowered the break even. I've lowered the cost basis into the position, which some of you stock traders could do with averaging down, but I didn't have to put more money into this trade to average down, did I? I took the second asset I already owned to help me lower the cost basis to be better prepared for further upside profits going forward. That's the benefit of having multiple tools in your position multiple tools in your toolbox for your position, whether the stock moves up to the bullish skew as we expected, if the stock's stagnating, or even if the stock falls and moves against our expectations, I still have ways to adjust it without increasing my potential risk. Or I could make the choice to maybe increase the risk, but to have the potential to profit in both directions. That is the benefit. I don't know if I'm going to do anything on NRG today. I might, but I have a lot of tricks up my sleeve and combinations I could even use at this point to generate more income to lower the risk, leave the upside open without increasing the risk on the potential trade. So, taking all that into account, taking a breath and clearing our heads for a minute, what did we show you? Well, on the SH trade, I showed you bulletproofing with a simple covered call. What you may be doing now, but with no risk in either direction, with the expectation of maybe the stock stagnating. We discussed some of the rules of income method and why I would do it, why I wouldn't sell the call at a lower strike price, and what are the pros and cons of this structure and how it would match the CEGA model. We also showed income method number 3, using the second asset, not just as insurance, but a way, because I was properly structured from the beginning, to use that as a second asset to lower the risk, and what would happen if we combined those two. I didn't show you number 4 yet. It's one of my favorite ones to use if the stock's moving in a desired direction. We didn't really show that one. Hey, I also showed you a way that we could potentially have no risk and profit in either direction with what's known as income method number 12. But of course, the do's and don'ts of how to structure that and when to use it are discussed in the blueprint and, of course, in presentations for blueprint owners and Fusion subscribers as well. Now, I also showed you ideas for the negative. Using NRG, the portfolio tools and the position analysis showed me an income method number 9 opportunity that actually lowered the risk from 6.8 to about 6%. We looked at that, but then we evaluated a different way of moving the put down in price to lower my break even by sort of generating a premium, but at the same time moving it closer in with that bulletproof vest to lower the risk, leave the upside open. Now we kind of showed a way that we could combine that idea with generating other income. We talked about it. And then we did show a way to profit in both directions, but it didn't take off the risk for the time frame I wanted. Remember, I wanted to stay in March with energy to cross through the earnings on February 28th. If I rolled that put into January or sold to close my 2020 January put and bought 2 2019 January puts, I might have still had a low-risk position that could profit in either direction for the next 20 to 25 days. But I don't want to do that. I want to keep this out to March to cross through the February earnings with no fear of a massive loss. Much better than a stop order. If you pick up energy today and you set a stop order of 8%, let's say even 7%, where I'm at right now, and you just plan on holding it through February no matter what happens, well, you might get triggered before that. I've got a guaranteed exit that I can manipulate. But then earnings come out, and the stock drops 15%. You don't get filled at a 7% loss. You get filled at whatever the market can give you. So you take that 15% loss, which means you're going to need a 22, 23% gain to get back to break even. I still have a put. I have a put that guaranteed I couldn't lose more than 6.8% or 6% even if I moved it closer in time. And it's still a second asset that in that case, if energy falls 15% through at earnings, I can still manipulate that put as we showed today. Or prior to the earnings event, I can do a different manipulation to profit in either direction and still keep a controlled risk that's much better than a stop order. I threw a lot of ideas at you. I threw a lot of numbers at you. I know that may seem confusing. So which is the best? Well, again, what are the current conditions? What are the expectations going forward? What are your goals? from the simple generate income because I like to take in premium and see my cash on hand in my account move up, or to just lower the risk just in case, or both? Well, that's going to determine the action for either position. As I mentioned, we teach the CEGA model for all 12 income methods in the blueprint. But based on your expectations going forward and your goals, you might be in the same trade as me and do something different. If it lowered the risk, lowered the break even, left the upside open, or didn't based on your expectations, neither one of the adjustments that you or I are due, even if it's different, could be considered wrong. But we have the ability to do it different ways, which are both correct or all correct, because we had the proper structure to begin with and we had the right tools in our toolbox. By the way, there's also a 13th income method, which it looks like I might be doing with energy right now, and that's do nothing. I'm only at a loss of 2.9% with a stock down 8.5% in the last 8 or 9 days. I feel no pressure right now to make an adjustment. I didn't like the adjustments that I saw, although I do kind of like that March 41 put, taking the risk down to 6%, crossing through earnings. But I don't have to take action. I can wait for a better opportunity. I don't have the pressure, as you might with a covered call trade, to try to quickly roll down the call to hedge some of the loss. The 13th income method, do nothing. And that might be a potential. But I can only do this because I had the proper setup to start, I had the proper goal of what I wanted to see happen, and I had 12 different tools for the different market actions and reactions, different conditions, expectations going forward to meet my goals as well. And then we talked about this, I have more at my disposal to help me meet my goals than owning stock and needing to average down, putting more money into a bad position, throwing more money after bad, just averaging down, averaging down, averaging down. Very quickly, side note, I'm going to pause. I'm going to go back over to power options for a moment. For those of you, 17% that are just trading stock, or even the 33% that are just trading covered calls, later on when you have the time, I'm recording this and I'm going to send it to you when it's archived. What you may want to consider is go to powerup.com and go to the free webinars. It's going to copy this for you. This is a free page. It's a public page. powerup.com/webinars.asp. Click on the options concepts. Yes, click on options concepts, and there's a webinar here on manage your broken position. This shows you potentially a better way to get back to break even for a stock that has moved against you, a covered call that's against you, managing a sold put, a naked put that's now in the money, using our stock repair tool, where you can just simply plug in your stock, your cost basis, and it'll show you an options repair that might help you get back to break even faster if you think the stock's going to recover, without putting more money in, buying another 50 shares, buying another 20 shares, buying another 30 shares, hoping for a recovery. This allows you to bring in income and put you in a position to potentially get back to break even faster. Just go to the webinars page, click on options concepts, watch manage your broken position, and if you haven't done so yet, just take a 14-day free trial to Power Options and you can do the stock repair tool. Okay? Of course, that will also help those of you doing covered calls. Instead of just rolling down and out, there are different ways discussed there to help you get back to break even faster. Of course, those of you who are just trading spread positions, I do teach also there under the option strategies 7 to 8 ways to manage a credit spread position. And there's also discussion on managing long calls and long puts. Right? So I have tools for you. I have education for you to help you going forward. But I think, wouldn't we rather get caught in this position again, or get caught trying to average down and still watching the stock fall? Wouldn't we better like to start off with a position with no fear or worry in the proper structure, with a known controlled risk, Yeah, you have a known controlled risk with a bull put or bear call credit spread, but that structure is probably risking 8 times the potential profit. You probably have an 8-to-1 or 9-to-1 risk-reward ratio. Here I'm in a structure where I can't lose more than 5, 6, 7, maybe 8% of what I invested in the trade, guaranteed. And that's the worst case scenario. And time is on my side, as we saw, so I can manipulate the time and get into that as well. Manipulate the time, better the position, lower the risk, and more. Because I have the ability to use the 12 different income methods in the blueprint that we've tested, that we trade ourselves. Last week we talked about how not everything is an income method. A bull put credit spread I don't use in this structure. I'll use other credit spreads that won't add any risk in this nested trade. But I have 12 different tools to use, even 13, to meet the market conditions, my expectations, and the goals for the trade as well, with whatever the market throws at me. That's the benefit of radioactive trading, and that's what's taught in the blueprint. It's not just the proper structure, using the put as a second asset, that's absolutely discussed, but the proper way to use that put as a second asset if you've structured it properly in the first place, and other adjustments to generate income, as you're doing now, but without the fear of risk. Why do I want you to pick up the blueprint? Because I don't want you to lose money. I don't want to see you going into 2019 having the same headaches we've had the last 3 months, trying to manage X, Y, and Z up and down to hedge a little loss here, then trying to play catch-up as it increased in November, right before it fell again, rolling up and down, moving spreads this way and that way. I want you to be protected from the unknown so that you can keep more of your investments, your retirement fund, your IRA, and more. And I want you to pick up the blueprint because if the unknown comes, I want you to have the right tools to be able to meet your goals going forward without worry or without fear. And with no pressure to do anything, no knee-jerk reactions to sudden market movements of having to fear that I have to roll down my call now to hedge this $3 loss I just took on the stock or $8 loss I just took on the stock, or immediate fear of having to roll down the naked put because I'm afraid of getting assigned early, or fear of rolling the spread because, hey, I'm already at a 50% loss because it fell between the strike prices and I can't let that go to a 70 or 80% loss. I've got to move it now. No pressure to do anything if it doesn't match your CEGA model for the trade. And of course, I also want you to pick up the blueprint because I want you to take advantage of these end-of-year bonus offers. Our end-of-year bonus ends on December 31st. So if you pick up your blueprint before December 31st at midnight, you're going to get 2 months of Fusion subscription at radioactivetrading.com for free. I'm going to talk about that a little bit later. You're going to get one of our Mastery Series CDs, the 6 Mastery Series CDs. The first one, Foundations of Radioactive Trading, or FORTS, for free. We'll also give you 1 month of Power Options for free. Use the tools that we showed today for tracking and managing your positions, but also all of the patented tools for searching, analyzing, researching, and comparing positions before you trade them. We're going to throw in something called the Quick Start Guide to help you get started faster, and another video that's a compilation of 4 or 5 of our most requested and most popular webinars with other case studies and more. Of course, anyone who picks up the blueprint, you get email support for free. You can call me, you can email me at any time with your questions. Myself, Ernie, Greg, or one of the other staff members will get back to you and point you in the right direction, act as a second pair of eyes over your shoulder. And of course, right now until December 31st, we're going to throw in free shipping. The blueprint is a 250-page text that describes all you need to properly structure your trades, limit your risk in unknown markets, and the tools of the 12 different income methods to go forward. But it does cost shipping. It's usually $11 inside the US and $76 international. We're going to waive that for you. You get free shipping as well. Plus, the blueprint comes with a money-back guarantee. You pick up the blueprint. We'll send it out to you. You start going through it. You feel it's not quite for you or something's not clicking. First of all, call me. Send me an email. Call me. and we'll talk about your concerns. But if you just feel it's not for you, send it back to us. Within 30 to 45 days, we'll refund your purchase, no questions asked. That's what you get if you pick up the blueprint before December 31st. Now, why do you need those 7 bonuses? Well, to have you have the right tools in addition to the right tool being the blueprint. We'll send you the link to that Foundations of Radioactive Trading video right away. You can watch it while you wait for your blueprint to arrive. Same with that FIST video, the 4 videos, requested webinars that we have. You'll get access to that right away. Same with the quick action guide. You'll get all 3 of those right off the bat, so while you're waiting for the blueprint to arrive, you can get more insight into the basics of the structure, the benefits of limited risk trading, and more. Some of the case studies of different income methods, riskless spread trades and beyond, and of course tips to help you get started more quickly putting this to work in your account with a controlled risk, so you don't have to stand on the fences there worrying about the market conditions. You can still play the benefits of the market knowing you have a guaranteed controlled risk. Why do you need Fusion? Fusion at RadioActiveTrading.com. It's a subscription service that's usually $69. With this end of the year promotion, you get your first 2 months of the Fusion subscription for only $10. $10 per month, $20 total for 2 months. What's included in Fusion? You get access to various lessons to help you master the radioactive trading techniques and what's in the blueprint. The RPM report shows you exactly which married puts Ernie or myself or one of the other staff would be opening today if we were to open a new radioactive trade. It's the same criteria that we use and the same list that we choose from. Based on the rules in the blueprint, based on what's worked for us for the past 10 years and what has worked for Kurt, the original creator of radioactive trading, for over the past 20 years. In addition to that, of course, you also see our trades. You can go through our track record of the married put techniques that were in our portfolio. The current married puts radioactive trades we have open right now, including NRG, Starbucks that I mentioned today, and others for Ernie. I talk about my own trades. I don't talk about his. I'll let him talk about his trades. Of course, you also have access to the stock repair tool and the stock insurance tool to help you, even if you have stock right now that's down. The stock insurance tool will show you ways you could potentially structure it in a radioactive trade now to further reduce additional losses or to be in the proper structure to still use the 12 income methods. Okay? But you don't have to do that right away. The benefits of the Fusion subscription you can activate when you're ready. So you pick up the blueprint, you get the Forts video, Foundations of Radioactive Trading, you get the FIST video to help you get started, watch while you wait, the quick action guide, then you get your blueprint, start going through it, then you can take advantage of the Fusion when you feel you're ready. And then, when you feel you're even more ready to go at your own, or put in your own positions, or even look for other strategies, if you want to, you can take your 30 days of power options when you're ready. It doesn't start right away, it starts when you're ready. And you saw the power of that today. Benefits alone of the portfolio tools to properly track and manage linked positions as a strategy. We saw I had 2 married puts open. We might see 2 married puts, 3 collars, 2 calendar spreads. They'd all be linked together rather than at your broker where it's just short call, long stock, long put, long put, long put, short put, 2 credit spreads, a debit spread, and a married put thrown in together, but it's not organized in that way. More importantly, every strategy that we track in Power Options, standard option strategy that we track, you can go to that position analysis tool and see rollout opportunities, where we do the math for you and you can do the side-by-side comparison, even if you're just trading stock. Even if you have a covered call, a naked put that's moving against you, credit spread, just a long call or a long put that's gaining or losing, you'll be able to see rollout opportunities for those positions. But tracking the married puts, it's a great benefit because it shows me which opportunities match the rules in the blueprint to help me lower risk, generate income, and more. And of course, the support. It always helps to have a second pair of eyes over your shoulder. If you want to make a decision, hey, should I be using income method number 1, income method number 3? We can't tell you what to do, but we'll review the pros and the cons for you, walk you through it, and make sure you're not missing anything as well. Of course, free shipping, our gift to you. And last but not least, all this month we've been talking about controlling risk limiting risk and potentially bulletproofing a trade where we have no risk. That's why we offer the money back guarantee. We're going to start our relationship off on the right foot. You pick up the blueprint, but you feel it's not for you, and send it back to us. We'll refund your purchase price. It's essentially a bulletproof proposition to begin with. There is no risk to you at all. Your next step, of course, well, this is going to be archived, and I'm going to send you the recording. But remember, special bonus offer ends December 31st, 4 days away at midnight. To pick up your copy, go to radioactivetrading.com/EOY. You'll see some other benefits and other discussion there for you to help you with maybe any general questions that you have. You can also just go to radioactivetrading.com and click the Products tab, pick up your blueprint, get those 7 bonuses, including the free shipping, money back guarantee, of course, and more before December 31st at midnight. Doug, you sent in a question. You said, should I call in later with this question? I don't think you asked the question first. I just saw that pop. There you go, Doug. Okay. Sorry, Doug. Okay, I'm going to go back a second to answer Doug's question. I apologize here. Actually, you know what? Doug, I'm going to email you shortly after this. I'm going to take a look at your question. I'm going to email you. But I'm going to share it with everyone else there. You bring in a comment. You said, is there a guideline to how much to pay for a married put? Looking at MSI, it's trading around 110. Could I buy a stock at that and then buy a January 2/20 put for approximately $50? I wouldn't do that. Okay. Talking about the proper structure a few webinars ago. We talked about the proper structure, the benefits of limiting risk. The one thing you don't want to do, Doug, is hedge yourself too deep. We typically don't go more than 15 to 20% in the money with our put options. Although you'd get a lower risk going deeper in the money, you've essentially hedged yourself out of the position with too much insurance, and your expectancy of profit is too low. And you said you're almost bulletproof at that point. Wouldn't selling calls be a good idea? No. Okay. Why do I bring that up? Well, if you did a proper structure, it might, or it might not. Okay. What did I promise you guys? I promised that if you pick up the blueprint, you can call or email us with any questions at any time to have a second pair of eyes over your shoulder. Well, let's put that into action. What I would do right now, if Doug called me up on the phone, if Doug was on a coaching session with me, if he was a subscriber to Power Options or Radioactive Trading, and he scheduled a coaching session, a one-on-one talk with myself or Ernie, or as I mentioned, he just emailed in or called in out of the blue, what would I explain? Well, the first thing I'm going to do, am I back on Power Options, folks? My apologies. Yes, I am. First thing I need to do is change the tab. I'm going to add married puts. I didn't have it here from our webinar on Friday. Let me add married puts back in. I'm going to be real quick with this. So married puts in. The first thing I'm going to do, Doug, is we're going to go to, I'm sorry, forgot about that. There's the webinar's link there. I forgot to send it. I just did. Anyway, let's go to married put. Let's go to search by symbol. Is MSI, Doug, I believe? That's what you said. And let me go to January 2020. For right now, I'm going to click on more results. Perfect. MSI at 109.91. We talked about this. We showed this a little bit in the last webinar. I only took more results, but immediately I can tell you where my eyes are gravitating to the proper structure that's discussed in the blueprint. These 3 right here. 115, 120, 125. Risk of 5%, 7.5, or 8.8. Okay? In this situation, my eyes will tend to gravitate towards the middle of the pack. Why am I focusing on these 3? Because they're the ones that are slightly in the money. They give me the single-digit risk I'm looking for without going too deep in the money where I need too much movement to have a profit. Why do I say that? Let's take a look at your potential trade. You were thinking of going to, I'm sorry, I want to just shift to all results. My apologies, Doug. Let's go to all results. Let's open it up. Your 150 that you mentioned, 42.70 in price, it's roughly 45% in the money, carries a risk of only 1.7%. You get filled at a little better midpoint, You might be lower than that, only 1% risk. Let me take a look at it in the profit and loss chart. When we were in our discussion, I mentioned the NRG trade at 45. And I showed using that income method number 3 to maybe lower the strike down and closer in, still carried a 6% risk, but it was now at a 43 put. And I said I'd have the opportunity to do other income methods if there is a recovery, if it does what I expect it to, right? Why wouldn't I just sell the 40 call with the stock at 37 and I have a 45 put? It's because I create a bearish position, which was against my expectations of what I would have done. Here's what I mean. At midpoint, here's your low risk position with the deep in the money, 45% in the money, 150 put on a stock trading at 109. You pay 41.03. You've got a low risk of 94 cents, 0.6%. What else do we have? I have a cost basis of 150.93, 150.94. Why is that important? I have a low risk. As Doug mentions, I'm almost bulletproof on the position. He says now I can just sell calls against it. What calls are you going to sell? What calls have any premium? Let's take a look. I'll go out to January. Standard expiration. 110 at 380, that's pretty good. 115, this one here, the 120 almost bulletproofs it. There's a small premium, about 10 cents for the 150 call. Can't do that. Yeah, I want to reward myself. This would essentially bulletproof that trade if I got near midpoint, right? Selling the 120 call. This is a no-no of the income methods. What happened? My risk went up to 20%. How can my risk potentially go up to 20%? It should have bulletproofed the trade. Well, it did, to the downside. Remember, your cost basis is still up at 150, and you just gave yourself an obligation to deliver shares of stock at 120. This is not a structure I want. What did I do? I sold the call too low of a strike price, too far below my put, for too little of a premium, too soon, and I've created a bearish position on a stock I was initially bullish on. Would this work if MSI just keeps falling down and down and down? Yeah. But if my anticipation was MSI would keep falling down, I'd open a different limited risk structure we talk about in a webinar for blueprint owners called Playing the Bear Side of the Market. Rather than do this, which is just a small return, and that 1.1%, by the way, is only right here. If the stock's trading at 120, okay, you've canceled the risk down here, but if it moves up, you've got to move this call. You've got to start reacting and pay more money into the position, which will increase the initial at risk. It's the wrong structure. You say, oh, well, let me go out to February. Instead, let me do something higher. Let me go out to February and sell, let's say, the 140 call. Now, 130. Better midpoint. All right, is this any better? Well, you've got a capped gain at 3.2% if and only if the stock's trading right at 130 at February expiration. You increase your risk in the upside in the initial direction you thought the stock was going to go from 7%, to 13.3%. Whereas if I created its structure properly, I'd have unlimited upside profit potential and only a risk of 7% to the downside. And if I did use that 115 or that 120 put, and MSI recovers and moves back to 112, 115, I could sell that call now and probably cancel half the risk, the February 120, the January 120. Cancel half the risk, only have a 3% risk with no risk to the upside, and maybe a potential 6% gain. This is not the proper structure. The expectancy of profit is too little because you've hedged yourself out too much. You can sell premium against it if you want to, but you're putting yourself in the wrong direction because the only premium you're going to get in this deep in the money structure is a call that's lower than the put. That creates a bearish position where you lose or increase the risk by having to roll that call in the direction you thought the stock was going to go. This, again, in my opinion, and you can disagree with me, this is a good question to ask. This is a great question to ask. But I think I've just shown why it is important to pick up your copy of the blueprint if you want to properly limit risk. Because if you go off on your own, you might set up the wrong structure. Not only set up the wrong structure, but put yourself in a structure that has a very low expectancy of profit, and at the same time, you may be trying to force an income method incorrectly, which could get you into trouble and increase your risk, rather than doing it in the proper way. My analogy again, having the right tools in your toolbox. Having multiple tools to do what you want to do and to achieve your goals for your project, your trade, or your investment. If I'm doing this little project here and I'm trying to turn these wood blocks into holiday craft snowflakes, do I want to cut wood with a drill? No, I want to use the saw. Drill is a tool that I use. It's an income method that I need, but I don't want to use it incorrectly to make the project worse. Selling the call is a preferred income method, but doing it incorrectly can get you into trouble and can destroy the project or can destroy the trade quickly, where you're moving in the wrong direction. Meaning as the stock's moving up in the initial direction you thought, you're adding more money to buy to close that call to avoid assignment and cap a loss, which is increasing your risk even though the stock's going in the proper direction. That's an incorrect use of one of the income methods. So I wouldn't use the drill to cut the wood, and I wouldn't use the saw to glue the wood together. Those are tools I need. Income method number one, selling call, is a preferred and used income method on a regular basis, but used incorrectly, it's going to hurt you going forward. And again, would it work if MSI just kept dropping and dropping and dropping and you keep selling calls that are out of the money, it continues to drop and you've got a no-risk trade? Yeah, there's so many better things that you could do in a limited risk structure to profit at that point, rather than just gaining 80 cents or 90 cents against a low risk trade, having a put and a cost basis way up here at 150 while the stock's dropping to 92, 93, or $94. Other ways we could do to take much more advantage of that, discussed in the blueprint. So again, I'll get this posted for you and we'll share that. Doug, I hope that helped answer your questions. Go to radioactivetrading.com EOY to pick up your blueprint before December 31st, or just go to radioactivetrading.com as well. Well, I've been harping about it. I've been talking about it. I've shared with you my opinions on it, but tell me, how do you feel about a structured trade and the education to have more than one tool at your disposal to go forward into the next unknown markets of 2019? Do you feel that the structure alone would have changed your trading year? Just setting up that limited risk proper structure with a 5 to 6% loss would have changed your trading year for the better? Do you feel that having these adjustments is much better than just rolling down a call, rolling it further out in time, and trying to scramble to manage it to move it up or down? Do you feel that having the second asset, not just insurance, is more than worth it without even talking about the other ways to generate income? Of course, would you like to see more ways to potentially lower the risk and beyond? And honestly, I only have a few people who have voted here on this poll. I'm going to leave it up for a little bit longer. But honestly, do you feel it seems too complicated? All right, so I'm going to leave this open for another 30 seconds. We're going to close up. I knew I'd go over today. I didn't expect to go 25 minutes over or so, but that's fine. We got a lot of good education. Got a lot crammed into this, why it's important that we're going to have, of course, the archive posted for you as well. All right, let me just close the poll and share the results with everyone that we have so far. 75% of you say having the second asset, not just as insurance, is more than worth it. Absolutely. 25% said it seems too complicated. Well, I tell you what, that's why the blueprint is available, because you can read it on your schedule. You can go through it on your schedule with still having all the bonuses available ready to take advantage of. Of course, it seems too complicated right now. I just threw a lot of things at you. I showed you ideas of 3 or 4 different income methods to use in different scenarios in a 1 hour and 15-minute time period. Naturally, that's going to seem complicated. The benefit of having the blueprint is not only having all of this at your disposal, each income method described and how and when you could use it that you can reference back to. Blueprint owners also get advantage of being able to see previously archived webinars in smaller snippets for specific income methods. In addition to that, continuing members-only webinars to talk about case studies, whens and hows to do different things, to help you master the techniques, and you may even find that of the 12 different income methods, you only use 4 or 5 on a regular basis, and there is nothing wrong with that. I haven't used what's known as income method number 8 in probably 5 years. Just doesn't usually match my CEGA model, and that's okay. I've used it in the past. I haven't used it in 5 years. Market conditions weren't right. My expectations weren't the same for that strategy, but it's available if I need it. The blueprint dispels all the complications. It's very hard to try to master these techniques and go into the approach just after watching one of these presentations. That's why the blueprint is there, and that's also why we offer the money-back guarantee, because if you don't feel it's for you, you can send it back to me, no questions asked, and refund it as well. All right. Okay, let me answer this question real quick, and then we'll wrap up for today. If you do have any last-minute questions, it's Billy Bob. Billy Bob sent in a question. He says, Michael, I have the blueprint from a long time ago. My blueprint only goes up to income method number 10 as the last income method. It says 5th edition. Is there a way to get the updated stuff for it? Yes. There's 2 ways to do it. I will send you an email. Number 1, most blueprint owners can log on to their free registration account at RadioActive Trading. You were given a password, and way back when, but I'll send it to you, Billy Bob. And what that does is you can go in and see the PDF versions of all of the updates from your edition to the most recent edition, edition number 14, I believe, or 15. If you have an older blueprint, 1, 2, or 3, what we typically do is ask you to buy a new blueprint at a severely reduced price. We'll only charge you $39 if you already own the blueprint to pick up a new blueprint that's the most updated edition. But I believe, Billy Bob, you'll be able just to download those PDF documents there to see the changes and the updates from your edition to where we are right now. And you'll have that for all time. Anytime we make an adjustment or an update, you'll be able to go check that out and download it as well. And then you add on that you, oops, I'm sorry, folks. I'm sorry, you added on that you think you want to sign up again for Power Option Service. If I do sign up, can I get the latest edition? Well, yeah, you can do it without signing up, but absolutely, I think Power Options is going to help you implement this, not only implement this technique, but track, manage, and watch and evaluate rollout opportunities where we do all the work for you as well. You'll get the additions without that. You'll get the additions, I should say, without that to update your blueprint, Billy Bob. I'll send you an email later with the specifics of how to do that based on your addition to where we are now. All right, ladies and gentlemen, thank you for joining me today. I hope you got some useful information out of today's presentation. I know it might have seemed like a lot, and of course it is, because we wanted to show what is possible in multiple scenarios with this to put you in a better position to not only have limited risk in place, but to be able to adjust that in different market conditions without increasing the risk, still getting the benefit of unlimited upside profit or matching your expectations and your goals. We didn't share everything. That's why the blueprint is there, is to help dispel all of that and to help break it down to your needs. And then we're always here for assistance as well for blueprint owners and more. Okay? Doug just wrote in and says, thanks so much, life-changing for my future retirement. Doug is a blueprint owner, of course, also is a member of Power Options as well. Thank you, Doug. I'm glad to see that's working out for you well. But remember, special offer ends December 31st. Go to radioactivetrading.com/EOY to pick up your blueprint before the end. And if you do have any questions, give me a call or send me an email at any time. Now, I'm not going to be available on the phone for the next 25 to 30 minutes, but other staff members will be available to answer any questions you have, and I'll be back on for the rest of the afternoon, although I do believe I have a 3 o'clock coaching session today. But we'll still be available. Someone's going to be available today. Just to let you know, I'm not going to be available for the next 25 minutes or so. All right, ladies and gentlemen, thank you very much for joining me again. Have a great evening. Have a great rest of your weekend. I'll let you know when this is posted. Take care and happy trading.